Understanding blockchain Layer 1 versus Layer 2 solutions. Blockchain technology has revolutionized how we handle data, transactions, and decentralized applications, DApps. However, as blockchain adoption grows, challenges like scalability, speed, and cost have become more apparent. To tackle these issues, developers have introduced Layer 1 and Layer 2 solutions. These terms are frequently used in the blockchain world, but what do they mean, and how do they differ? In this video, we'll explore the concepts of Layer 1 and Layer 2 solutions, their use cases, and their impact on the blockchain ecosystem. Before diving into Layer 1 and Layer 2, it's important to understand the basic structure of a blockchain. A blockchain is a decentralized, distributed ledger that records transactions across a network of computers. It consists of blocks, which are containers that store transaction data, nodes, which are computers that validate and relay transactions, and consensus mechanisms, which are protocols that ensure all nodes agree on the state of the blockchain. While this architecture ensures security and decentralization, it often struggles with scalability and efficiency, especially as the network grows. This is where Layer 1 and Layer 2 solutions come into play. Layer 1 refers to the base blockchain protocol itself. It is the foundational layer where all transactions are recorded and validated. Examples of Layer 1 blockchains include Bitcoin, Ethereum, and Solana. Layer 1 blockchains are fully decentralized, meaning no single entity controls the network, and transactions on Layer 1 are highly secure due to robust consensus mechanisms. Additionally, once data is recorded on Layer 1, it cannot be altered, ensuring immutability. However, Layer 1 blockchains often face scalability issues because every transaction must be processed by every node in the network. This leads to slow transaction speeds and high fees, especially during peak times. For example, Bitcoin processes about 7 transactions per second, TPS, while Ethereum handles around 30 TPS. To address these challenges, developers have introduced several Layer 1 scaling solutions, such as consensus mechanism upgrades, sharding, and block size increases. For instance, Ethereum's transition from proof of work, POW, to proof of stake, POS, in Ethereum 2.0 aims to improve scalability and energy efficiency. On the other hand, Layer 2 refers to secondary protocols built on top of Layer 1 blockchains. These protocols aim to enhance scalability and efficiency by handling transactions off-chain or in a more optimized manner. Examples of Layer 2 solutions include the Lightning Network, for Bitcoin, and Polygon, for Ethereum. Layer 2 solutions can process thousands of transactions per second, significantly improving throughput, and by reducing the load on Layer 1, they can drastically lower transaction fees. Many Layer 2 solutions are also designed to work seamlessly with multiple Layer 1 blockchains, enhancing interoperability. There are several types of Layer 2 solutions, including state channels, rollups, and sidechains. State channels allow users to conduct multiple transactions off-chain and only sell the final state on Layer 1, as seen in the Lightning Network. Rollups bundle multiple transactions into a single transaction and submit it to Layer 1, with optimistic rollups assuming transactions are valid, unless proven otherwise, and ZK rollups using zero-knowledge proofs to validate transactions off-chain. Sidechains are independent blockchains that run parallel to the main chain and are connected via a two-way peg, such as Polygon. Layer 1 and Layer 2 solutions differ in several key aspects. Layer 1 is the base blockchain protocol, while Layer 2 refers to secondary protocols built on top of Layer 1. Layer 1 is limited by network size and consensus mechanisms, whereas Layer 2 offers high scalability through off-chain processing. Layer 1 is slower, while Layer 2 is faster, and Layer 1 transactions are more expensive, while Layer 2 transactions are cheaper. Layer 1 is highly secure, while Layer 2's security depends on the underlying Layer 1 blockchain. Layer 1 is ideal for core blockchain operations, while Layer 2 is better suited for high-frequency transactions in DApps. Layer 1 and Layer 2 solutions have distinct use cases. Layer 1 is ideal for storing value securely, as seen with Bitcoin, and for enabling the creation of decentralized applications, DApps, and smart contracts, as with Ethereum. Layer 1 blockchains like Tezos are also used for decentralized governance. Layer 2 solutions, on the other hand, are better suited for micropayments, as demonstrated by the Lightning Network, and for blockchain-based gaming, as seen with Immutable X. Layer 2 protocols like Arbitrum and Optimism also enhance the scalability of decentralized finance, DeFi, applications. Both Layer 1 and Layer 2 solutions have their pros and cons. Layer 1 offers high security and decentralization, an immutable and transparent ledger, and is suitable for core blockchain operations. However, it suffers from limited scalability, slow transaction speeds, high transaction fees during peak times, and requires significant energy and resources. Layer 2, on the other hand, offers high scalability, fast transaction speeds, low transaction fees, and enhances user experience for DApps and high-frequency transactions. However, its security depends on the underlying Layer 1 blockchain. It may introduce complexity and interoperability challenges, and it is still evolving, which may limit adoption in some areas. The blockchain ecosystem is continuously evolving, and both Layer 1 and Layer 2 solutions play a crucial role in its growth. While Layer 1 blockchains provide the foundation for security and decentralization, Layer 2 solutions address scalability and efficiency challenges. In the future, we can expect increased integration, with more Layer 2 solutions being developed to work seamlessly with Layer 1 blockchains. Hybrid models that combine the strengths of Layer 1 and Layer 2 to create more robust and scalable networks are also likely to emerge. As scalability improves, blockchain technology will see broader adoption across industries. Understanding the difference between Layer 1 and Layer 2 solutions is essential for anyone involved in the blockchain space. Layer 1 provides the foundation for security and decentralization, while Layer 2 enhances scalability and efficiency. By leveraging both layers, developers and users can unlock the full potential of blockchain technology. Whether you're building a dApp, investing in cryptocurrencies, or simply exploring the technology, knowing how these layers work will help you make informed decisions and stay ahead in the ever-evolving blockchain ecosystem. This video provides a comprehensive overview of Layer 1 and Layer 2 solutions. If you're creating a video on this topic, consider including real-world examples and comparisons to make your content more engaging and informative. Good luck with your video. Unlock the future of blockchain scalability. Like, subscribe, and hit the notification bell for more insights. Drop your thoughts in the comments. Crypto security. How to safeguard your digital assets from hacks. As cryptocurrencies continue to gain popularity, the importance of securing your digital assets cannot be overstated. Unlike traditional financial systems, cryptocurrencies operate on decentralized networks, which means there is no central authority to reverse transactions or recover lost funds. This makes crypto security a critical responsibility for every investor and user. In this video, we'll explore practical steps you can take to safeguard your digital assets from hacks, scams, and other security threats. The first step in securing your crypto assets is understanding the types of threats you may face. Hackers and scammers employ a variety of tactics to steal digital assets, including phishing attacks, malware, fake websites, and social engineering. Phishing attacks, for example, involve tricking users into revealing their private keys or login credentials through fake emails or websites. Malware, such as keyloggers or clipboard hijackers, can steal sensitive information from your device. Fake websites and apps mimic legitimate platforms to deceive users into entering their credentials. Social engineering involves manipulating individuals into divulging confidential information. By being aware of these threats, you can take proactive measures to protect yourself. One of the most effective ways to secure your crypto assets is by using a hardware wallet. Hardware wallets are physical devices that store your private keys offline, making them immune to online hacks. Unlike software wallets, which are connected to the internet and therefore more vulnerable, hardware wallets provide an additional layer of security. Popular hardware wallets include Ledger and Trezor. When using a hardware wallet, always purchase it directly from the manufacturer or an authorized reseller to avoid tampered devices. Additionally, set up a strong PIN and write down your recovery seed phrase, storing it in a secure location offline. Another crucial aspect of crypto security is practicing good password hygiene. Use strong, unique passwords for all your crypto-related accounts, including exchanges, wallets, and email addresses. Avoid reusing passwords across different platforms, as this increases the risk of multiple accounts being compromised if one password is leaked. Consider using a password manager to generate and store complex passwords securely. Enable two-factor authentication, 2FA, wherever possible, as it adds an extra layer of protection by requiring a second form of verification, such as a code from an authenticator app or a text message. Be cautious when interacting with online platforms and services. Always double-check URLs to ensure you're visiting legitimate websites and avoid clicking on suspicious links in emails or messages. Scammers often create fake websites that look identical to popular crypto platforms to steal login credentials. Bookmark the official websites of your preferred exchanges and wallets to reduce the risk of landing on a phishing site. Additionally, download apps only from official app stores or the platform's website, as third-party app stores may host malicious software. Regularly updating your software and devices is another essential step in maintaining crypto security. Software updates often include patches for vulnerabilities that hackers could exploit. Ensure that your operating system, antivirus software, wallet apps, and browser extensions are up to date. Avoid using public Wi-Fi networks when accessing your crypto accounts, as these networks are often unsecured and can be easily intercepted by hackers. Instead, use a virtual private network, VPN, to encrypt your internet connection and protect your data. Diversifying your storage methods can also enhance the security of your digital assets. Instead of keeping all your crypto in a single wallet or exchange, spread your holdings across multiple wallets, including hardware wallets, software wallets, and paper wallets. This reduces the risk of losing all your assets in case one wallet is compromised. For long-term storage, consider using cold storage methods, such as hardware wallets or paper wallets, which are not connected to the internet and are therefore less vulnerable to hacks. Educating yourself about common scams and staying informed about the latest security threats is vital for protecting your crypto assets. Scammers are constantly evolving their tactics, so staying vigilant is key. Be wary of unsolicited messages or offers that seem too good to be true, such as promises of guaranteed returns or free crypto giveaways. Legitimate projects and platforms will never ask for your private keys or recovery phrases. If something feels off, trust your instincts and verify the information through official channels. Finally, consider using decentralized finance, DeFi, platforms and non-custodial wallets to maintain control over your private keys. Unlike centralized exchanges, which hold your funds on your behalf, non-custodial wallets give you full control over your assets. While this means you are solely responsible for securing your private keys, it also eliminates the risk of exchange hacks. When using DeFi platforms, always research the project's security measures and audit history to ensure it is trustworthy. In conclusion, safeguarding your digital assets from hacks requires a combination of proactive measures, awareness, and vigilance. By using hardware wallets, practicing good password hygiene, avoiding phishing scams, keeping your software updated, diversifying your storage methods, and staying informed about security threats, you can significantly reduce the risk of losing your crypto assets. Remember, the decentralized nature of cryptocurrencies means that security is ultimately in your hands. Take the necessary steps to protect your investments and enjoy the benefits of this revolutionary technology with peace of mind. Additional tips for advanced crypto security. For those looking to take their crypto security to the next level, here are some advanced strategies to consider. Multi-signature wallets. Multi-signature, multi-sig wallets require multiple private keys to authorize a transaction. This adds an extra layer of security, as hackers would need to compromise multiple keys to access your funds. Multi-sig wallets are particularly useful for businesses or individuals managing large amounts of crypto. Cold storage. Cold storage refers to keeping your private keys completely offline, away from any internet-connected device. This can include hardware wallets, paper wallets, or even physical items like metal plates engraved with your seed phrase. Cold storage is one of the safest methods for long-term crypto storage. Decentralized exchanges. DEXs, centralized exchanges, are often targeted by hackers due to the large amounts of crypto they hold. Using decentralized exchanges, DEXs, can reduce your exposure to exchange hacks, as DEXs allow you to trade directly from your wallet without depositing funds on the platform. Regular security audits. Periodically review your security practices and update them as needed. This includes checking for software updates, reviewing your wallet backups, and ensuring your recovery seed phrase is stored securely. Regular audits help you stay ahead of potential vulnerabilities. Use a dedicated device. Consider using a separate device exclusively for crypto transactions. This device should have minimal software installed and be used solely for accessing your wallets and exchanges. By isolating your crypto activities, you reduce the risk of malware or other threats compromising your assets. Beware of SIM swapping. SIM swapping is a tactic where hackers take control of your phone number by convincing your mobile carrier to transfer it to a new SIM card. Once they have control, they can bypass 2FA that relies on SMS. To protect against SIM swapping, use authenticator apps for 2FA instead of SMS and contact your mobile carrier to add extra security measures to your account. Monitor your accounts. Regularly check your crypto accounts and wallets for any unauthorized activity. Set up alerts for transactions and logins to stay informed about any changes. Early detection of suspicious activity can help you take immediate action to secure your assets. Backup your wallet. Always create backups of your wallet and store them in multiple secure locations. This ensures that you can recover your funds if your primary device is lost, stolen, or damaged. Use encrypted USB drives or other secure storage methods for your backups. Avoid sharing personal information. Be cautious about sharing personal information online, especially on social media. Hackers can use this information to target you with phishing attacks or social engineering scams. Keep your crypto activities private to reduce the risk of being targeted. Stay informed about new threats. The crypto landscape is constantly evolving, and new security threats emerge regularly. Follow reputable crypto news sources, join online communities, and participate in forums to stay updated on the latest security practices and threats. Protect your crypto like a pro. Subscribe now for expert tips, and don't forget to like and comment with your security strategies. How to use NFTs as an investment strategy. Non-fungible tokens, NFTs, have taken the world by storm, transforming the way we think about digital ownership and creating new opportunities for investors. From digital art and collectibles to virtual real estate and gaming assets, NFTs have opened up a vibrant and rapidly evolving market. However, like any investment, NFTs come with risks and require a well-thought-out strategy to maximize returns. In this video, we'll explore how to use NFTs as an investment strategy, covering everything from understanding the basics to advanced tactics for success. To begin, it's essential to understand what NFTs are and how they work. NFTs are unique digital assets stored on a blockchain, typically Ethereum, that represent ownership of a specific item or piece of content. Unlike cryptocurrencies such as Bitcoin or Ethereum, which are fungible and interchangeable, NFTs are one of a kind and cannot be replicated. This uniqueness is what gives NFTs their value, as they can represent anything from digital art and music to virtual real estate and in-game items. The blockchain ensures the authenticity and provenance of each NFT, making it easy to verify ownership and track its history. The first step in using NFTs as an investment strategy is to educate yourself about the market. The NFT space is still relatively new and highly speculative, so it's crucial to understand the risks and opportunities involved. Start by researching the different types of NFTs and the platforms where they are bought and sold. Popular NFT marketplaces include OpenSea, Rarible, and Foundation, each catering to different types of assets and creators. Familiarize yourself with the terminology, such as minting, gas fees, and royalties, as well as the trends driving the market. Follow reputable sources of information, such as industry blogs, podcasts, and social media accounts, to stay updated on the latest developments. Once you have a solid understanding of the NFT market, the next step is to identify your investment goals and risk tolerance. Are you looking for short-term gains through flipping NFTs, or are you more interested in long-term holdings with potential for appreciation? Your goals will determine the types of NFTs you invest in and the strategies you use. For example, if you're focused on short-term profits, you might look for trending collections or undervalued assets that you can buy and sell quickly. On the other hand, if you're aiming for long-term growth, you might invest in high-quality digital art or virtual real estate with strong potential for appreciation. One of the most important aspects of NFT investing is conducting thorough research before making any purchases. This includes evaluating the creator, the project, and the community behind the NFT. Look for creators with a strong track record and a clear vision for their work. Research the project's roadmap and utility, as NFTs with real-world applications or benefits tend to hold more value. Additionally, assess the strength and engagement of the community, as a passionate and active fanbase can drive demand and increase the value of an NFT. Tools like Discord and Twitter are great for gauging community sentiment and staying informed about upcoming drops and events. Diversification is another key principle of NFT investing. Just as you wouldn't put all your money into a single stock, it's wise to spread your investments across different types of NFTs and projects. This reduces your exposure to risk and increases your chances of finding a winning investment. Consider allocating your portfolio to a mix of established blue-chip NFTs, such as CryptoPunks or Bored Ape Yacht Club, and emerging projects with high growth potential. You might also explore different categories, such as digital art, gaming assets, and virtual real estate, to take advantage of diverse opportunities in the market. Timing is critical in the NFT space, as prices can be highly volatile and influenced by trends and hype. Pay attention to market cycles and sentiment to identify optimal entry and exit points. For example, buying during a market downturn or after a project has been overlooked can provide opportunities for significant gains. Conversely, selling during a peak or when hype begins to fade can help you lock in profits. Keep in mind that the NFT market is still relatively young and speculative, so be prepared for sudden price swings and unexpected developments. Another strategy for NFT investing is to focus on utility and real-world applications. While many NFTs are valued for their artistic or collectible qualities, others offer tangible benefits that can drive demand and increase their value. For instance, some NFTs grant access to exclusive events, memberships, or virtual experiences. Others are used in gaming or virtual worlds, where they can be traded, upgraded, or used to generate income. By investing in NFTs with strong utility, you can position yourself to benefit from both their intrinsic value and their potential for appreciation. Participating in NFT drops is another way to acquire valuable assets at a lower cost. Many creators release their NFTs through drops, where a limited number of tokens are made available for purchase at a fixed price. These drops often sell out quickly, so it's essential to be prepared and act fast. Follow your favorite creators and projects on social media to stay informed about upcoming drops, and ensure you have the necessary funds and gas fees ready to complete the transaction. Keep in mind that not all drops are created equal, so do your research to identify high-quality projects with strong potential. Building relationships within the NFT community can also enhance your investment strategy. Networking with creators, collectors, and other investors can provide valuable insights, tips, and opportunities. Join Discord servers, attend virtual events, and engage with the community on social media to stay connected and informed. Collaborating with others can also open doors to co-investment opportunities or exclusive access to sought-after NFTs. Advanced strategies for NFT investing. For those looking to take their NFT investments to the next level, here are some advanced strategies to consider. Flipping NFTs. Flipping involves buying NFTs at a low price and selling them quickly for a profit. This strategy requires a keen eye for undervalued assets and an understanding of market trends. Look for NFTs with strong potential for growth, such as those from emerging artists or projects with upcoming announcements. Be prepared to act fast, as opportunities in the NFT market can disappear quickly. Staking and yield farming. Some NFT projects offer staking or yield farming opportunities, where you can earn rewards by holding or using your NFTs. For example, certain gaming NFTs allow you to earn in-game currency or items by staking them. Research projects that offer these benefits and consider incorporating them into your investment strategy. Fractional ownership. Fractional ownership allows multiple investors to own a share of a high-value NFT. Platforms like fractional.art enable you to buy and sell fractions of NFTs, making it easier to invest in expensive assets. This strategy can provide exposure to blue-chip NFTs without requiring a large upfront investment. Investing in NFT funds. NFT funds pool capital from multiple investors to purchase and manage a portfolio of NFTs. By investing in a fund, you can gain exposure to a diversified collection of assets without needing to manage them yourself. Research reputable funds and consider this option if you prefer a more hands-off approach. Creating your own NFTs. If you have artistic or creative skills, consider creating and selling your own NFTs. This can be a lucrative way to generate income and build your reputation in the NFT community. Platforms like OpenSea and Rarible make it easy to mint and list your NFTs for sale. Virtual real estate. Virtual real estate refers to digital land or properties in virtual worlds like Decentraland or the Sandbox. These assets can appreciate in value as the virtual world grows and becomes more popular. Consider investing in virtual real estate if you believe in the long-term potential of the metaverse. Collaborative investments. Partnering with other investors to purchase high-value NFTs can provide access to assets that might be out of reach individually. Collaborative investments require trust and clear agreements, but they can be a powerful way to diversify your portfolio and share risks. In conclusion, NFTs offer a unique and innovative way to invest in digital assets. By understanding the market, setting clear goals, and managing risk, you can unlock the potential of NFTs as a powerful investment strategy. Whether you're a seasoned investor or just starting, the NFT space offers a wealth of opportunities for those willing to explore and embrace its potential. Unlock the potential of NFTs as an investment. Like, subscribe, and comment below if you're ready to dive into the world of digital assets. The role of AI and automation in crypto trading. The cryptocurrency market is known for its volatility, 24/7 trading hours, and rapid price movements, making it both an exciting and challenging environment for traders. In recent years, artificial intelligence, AI, and automation have emerged as powerful tools to navigate this dynamic landscape. By leveraging AI and automation, traders can analyze vast amounts of data, execute trades with precision, and manage risk more effectively. In this video, we'll explore the role of AI and automation in crypto trading, their benefits, challenges, and how they are shaping the future of the industry. At its core, AI refers to the simulation of human intelligence in machines that are programmed to think, learn, and make decisions. In the context of crypto trading, AI can analyze market data, identify patterns, and predict price movements with a level of speed and accuracy that surpasses human capabilities. Automation, on the other hand, involves using software or algorithms to execute trades automatically based on predefined rules or strategies. Together, AI and automation enable traders to make data-driven decisions, reduce emotional bias, and capitalize on opportunities in real time. One of the most significant advantages of AI and automation in crypto trading is their ability to process and analyze large volumes of data. The cryptocurrency market generates an enormous amount of data every second, including price movements, trading volumes, social media sentiment, and news events. Manually analyzing this data is nearly impossible, but AI-powered tools can sift through it in milliseconds to identify trends, correlations, and anomalies. For example, AI algorithms can analyze historical price data to predict future movements or monitor social media platforms to gauge market sentiment. This data-driven approach allows traders to make more informed decisions and stay ahead of the curve. Another key benefit of AI and automation is their ability to execute trades with precision and speed. In the fast-paced world of crypto trading, even a few seconds can make a significant difference in profitability. Automated trading systems, also known as trading bots, can execute trades instantly based on predefined criteria, such as price thresholds or technical indicators. This eliminates the need for manual intervention and ensures that trades are executed at the optimal time. Additionally, AI-powered bots can adapt to changing market conditions in real time, adjusting their strategies to maximize profits or minimize losses. Risk management is another area where AI and automation excel. Crypto trading is inherently risky, with prices often experiencing sharp fluctuations in short periods. AI algorithms can assess risk factors, such as market volatility and portfolio exposure, and implement strategies to mitigate potential losses. For example, an automated trading system can set stop-loss orders to limit losses or diversify a portfolio to reduce risk. By automating risk management, traders can protect their investments and maintain a disciplined approach to trading. AI and automation also enable traders to backtest and optimize their strategies. Backtesting involves testing a trading strategy on historical data to evaluate its performance. AI-powered tools can simulate thousands of trading scenarios in a matter of minutes, providing insights into the effectiveness of a strategy under different market conditions. This allows traders to refine their strategies and improve their chances of success. Additionally, AI can identify patterns and correlations that may not be apparent to human traders, leading to the development of more sophisticated and profitable strategies. One of the most exciting applications of AI in crypto trading is predictive analytics. By analyzing historical data and identifying patterns, AI algorithms can predict future price movements with a high degree of accuracy. For example, machine learning models can analyze price charts, trading volumes, and other indicators to forecast whether a cryptocurrency is likely to rise or fall in value. These predictions can inform trading decisions and help traders capitalize on market trends. While no prediction is 100% accurate, AI-powered analytics can provide a significant edge in a highly competitive market. Sentiment analysis is another powerful tool enabled by AI. The cryptocurrency market is heavily influenced by news, social media, and public sentiment. AI algorithms can analyze social media posts, news articles, and other sources of information to gauge market sentiment and identify potential catalysts for price movements. For example, if a major news outlet reports a positive development for a particular cryptocurrency, AI tools can detect the shift in sentiment and alert traders to potential buying opportunities. This real-time analysis allows traders to react quickly to market-moving events. Despite their many benefits, AI and automation in crypto trading are not without challenges. One of the primary concerns is the risk of over-reliance on technology. While AI algorithms are highly effective at analyzing data and executing trades, they are not infallible. Market conditions can change rapidly, and unexpected events, such as regulatory announcements or security breaches, can disrupt even the most sophisticated algorithms. Traders must remain vigilant and be prepared to intervene if necessary. Another challenge is the complexity of developing and implementing AI-powered trading systems. Creating an effective AI algorithm requires a deep understanding of both machine learning and financial markets. Additionally, traders must have access to high-quality data and computing resources to train and deploy their models. For many retail traders, this level of expertise and infrastructure may be out of reach. However, the growing availability of user-friendly trading bots and AI-powered platforms is making these tools more accessible to a wider audience. Security is another critical consideration when using AI and automation in crypto trading. Trading bots and automated systems require access to exchange accounts and private keys, making them potential targets for hackers. Traders must take steps to secure their accounts, such as using two-factor authentication, 2FA, and storing private keys offline. Additionally, it's essential to choose reputable trading bots and platforms that prioritize security and transparency. The regulatory landscape is another factor to consider. As AI and automation become more prevalent in crypto trading, regulators are paying closer attention to their use. Some jurisdictions have implemented rules to govern algorithmic trading, such as requiring traders to disclose their use of automated systems or imposing limits on high-frequency trading. Traders must stay informed about the regulatory environment in their region and ensure that their activities comply with local laws. Despite these challenges, the role of AI and automation in crypto trading is only expected to grow in the coming years. As technology continues to advance, we can expect to see even more sophisticated tools and strategies emerge. For example, the integration of AI with decentralized finance, DeFi, platforms could enable new forms of automated trading and yield farming. Similarly, the development of quantum computing could revolutionize the way AI algorithms analyze data and make predictions. The future of AI and automation in crypto trading. The future of AI and automation in crypto trading is bright, with new technologies and applications emerging regularly. As AI algorithms become more sophisticated, we can expect to see even more accurate predictions and smarter trading strategies. The integration of AI with blockchain technology and decentralized finance, DeFi, could unlock new opportunities for automated trading and yield generation. Additionally, advancements in quantum computing could revolutionize the way AI analyzes data and makes decisions. In conclusion, AI and automation are reshaping the cryptocurrency trading landscape, offering traders powerful tools to navigate the market's complexities. By leveraging these technologies, traders can enhance their decision-making, improve efficiency, and achieve better results. However, it's essential to approach AI and automation with caution, ensuring that you understand the risks and implement robust risk management strategies. With the right approach, AI and automation can be valuable allies in your crypto trading journey. Discover how AI and automation are revolutionizing crypto trading. Don't forget to like, subscribe, and comment your thoughts below. How to identify and avoid crypto scams and rug pulls. The cryptocurrency market has grown exponentially over the past decade, attracting millions of investors and traders worldwide. However, this rapid growth has also given rise to a surge in scams and fraudulent schemes, including rug pulls, phishing attacks, and fake projects. These scams can result in significant financial losses and erode trust in the crypto ecosystem. For anyone involved in cryptocurrencies, knowing how to identify and avoid scams is crucial. In this article, we'll explore the most common types of crypto scams, how to spot red flags, and practical steps you can take to protect yourself from falling victim to these schemes. One of the most prevalent types of scams in the crypto space is the rug pull. A rug pull occurs when the developers of a cryptocurrency project abandon it after raising funds from investors, leaving them with worthless tokens. Rug pulls are particularly common in decentralized finance, DeFi, projects, where liquidity pools and token launches are often unregulated. To avoid rug pulls, it's essential to research the project thoroughly before investing. Look for a transparent and experienced team with a verifiable track record. Check if the developers have doxed themselves, revealed their identities, and whether they have a history of successful projects. Additionally, review the project's white paper and roadmap to ensure it has a clear vision and achievable goals. Be cautious of projects that promise unrealistic returns or use aggressive marketing tactics to lure investors. Another common scam is phishing, where attackers trick users into revealing their private keys, seed phrases, or login credentials. Phishing attacks often involve fake websites, emails, or social media messages that mimic legitimate platforms. For example, you might receive an email claiming to be from a popular exchange, asking you to verify your account by clicking on a link. Once you enter your credentials on the fake website, the attackers gain access to your funds. To avoid phishing scams, always double-check URLs and ensure you're visiting the official website of the platform. Avoid clicking on links in unsolicited emails or messages, and enable two-factor authentication, 2FA, on all your accounts. Additionally, use a hardware wallet to store your cryptocurrencies, as it provides an extra layer of security against phishing attacks. Ponzi schemes are another type of scam that has plagued the crypto industry. These schemes promise high returns with little to no risk, using funds from new investors to pay earlier participants. Eventually, the scheme collapses when there aren't enough new investors to sustain the payouts. One infamous example is the BitConnect scam, which promised guaranteed daily returns and collapsed in 2018, causing billions of dollars in losses. To avoid Ponzi schemes, be skeptical of any investment opportunity that guarantees high returns with no risk. Remember the old adage, if it sounds too good to be true, it probably is. Always conduct thorough research and seek independent advice before investing in any project. Fake ICOs, initial coin offerings, are another common scam in the crypto space. ICOs are a way for new projects to raise funds by selling tokens to investors. However, some fraudulent projects use ICOs to collect funds without any intention of delivering a product. These scams often involve elaborate websites, fake team members, and plagiarized white papers. To avoid fake ICOs, research the project's team and verify their credentials. Look for independent audits of the project's code and ensure the white paper is original and well written. Additionally, check if the project has a strong community and active social media presence, as these are signs of legitimacy. Pump and dump schemes are another type of scam that manipulates the price of a cryptocurrency for profit. In a pump and dump scheme, a group of individuals artificially inflates the price of a low-value cryptocurrency by spreading false information or creating hype. Once the price reaches a certain level, they sell their holdings, causing the price to crash and leaving other investors with losses. To avoid pump and dump schemes, be cautious of unsolicited investment advice, especially on social media or messaging platforms like Telegram. Avoid investing in cryptocurrencies that have little to no utility or real-world use case. Instead, focus on projects with strong fundamentals and a clear value proposition. Imposter scams are another type of fraud that targets crypto users. In these scams, attackers impersonate well-known figures or companies in the crypto space to gain your trust. For example, you might receive a message from someone claiming to be Elon Musk or a representative of a popular exchange, asking for donations or offering investment opportunities. These scams often involve fake social media accounts or websites that look identical to the real ones. To avoid imposter scams, always verify the identity of the person or organization before engaging with them. Check their official website or social media accounts for confirmation, and be wary of unsolicited messages or offers. Fake wallets and exchanges are another common scam in the crypto space. These scams involve creating fake versions of popular wallets or exchanges to trick users into depositing their funds. Once the funds are deposited, the attackers withdraw them, leaving the user with nothing. To avoid fake wallets and exchanges, always download apps from official sources, such as the App Store or Google Play, or the platform's official website. Avoid using third-party app stores or clicking on links from unknown sources. Additionally, check reviews and ratings before using a new wallet or exchange, and ensure it has a strong reputation in the crypto community. Social engineering attacks are another type of scam that relies on manipulating individuals into divulging confidential information. These attacks often involve building trust with the victim over time before asking for sensitive information, such as private keys or login credentials. For example, an attacker might pose as a customer support representative and ask for your seed phrase to resolve an issue. To avoid social engineering attacks, never share your private keys, seed phrases, or login credentials with anyone. Legitimate companies and platforms will never ask for this information. If you're unsure about a request, contact the platform's official support team directly to verify its authenticity. Malware and hacking attacks are another significant threat in the crypto space. These attacks involve infecting a user's device with malicious software to steal their cryptocurrencies. For example, keyloggers can record your keystrokes to capture your passwords, while clipboard hijackers can replace your wallet address with the attacker's address when you copy and paste it. To protect against malware and hacking attacks, use antivirus software and keep your operating system and applications up to date. Avoid downloading files or clicking on links from unknown sources, and use a hardware wallet to store your cryptocurrencies securely. Rug pulls in NFTs are another growing concern in the crypto space. These scams involve creating a non-fungible token, NFT, project, selling the NFTs to investors, and then abandoning the project without delivering on promises. To avoid NFT rug pulls, research the project's team and verify their credentials. Look for a strong community and active social media presence, as these are signs of legitimacy. Additionally, review the project's roadmap and ensure it has a clear vision and achievable goals. Be cautious of projects that promise unrealistic returns or use aggressive marketing tactics to lure investors. Fake airdrops and giveaways are another common scam in the crypto space. These scams involve offering free tokens or cryptocurrencies in exchange for a small fee or personal information. Once the victim provides the requested information or pays the fee, the attackers disappear, leaving the victim with nothing. To avoid fake airdrops and giveaways, be skeptical of unsolicited offers and always verify the authenticity of the offer. Legitimate airdrops and giveaways will never ask for your private keys, seed phrases, or payment. In conclusion, the cryptocurrency market offers exciting opportunities, but it also comes with significant risks. By understanding the most common types of scams and how to spot red flags, you can protect yourself from falling victim to fraudulent schemes. Always conduct thorough research, verify the authenticity of platforms and projects, and use secure practices to safeguard your investments. With the right knowledge and precautions, you can navigate the crypto space safely and confidently. Protect your investments. Learn how to spot and avoid crypto scams and rug pulls. Like, subscribe, and stay informed. The future of stablecoins and their role in cryptocurrency markets. Stablecoins have emerged as one of the most important innovations in the cryptocurrency ecosystem, bridging the gap between traditional finance and the digital asset world. Designed to minimize price volatility, stablecoins are cryptocurrencies pegged to stable assets like fiat currencies, e.g., USD, EUR, or commodities, e.g., gold. Their stability and utility have made them indispensable for trading, remittances, and decentralized finance, DeFi, applications. As the cryptocurrency market continues to evolve, stablecoins are poised to play an even more significant role. In this video, we'll explore the future of stablecoins, their growing importance, and the challenges they face in shaping the future of global finance. The rise of stablecoins. Stablecoins were created to address the inherent volatility of cryptocurrencies like Bitcoin and Ethereum. While these digital assets offer revolutionary features such as decentralization and transparency, their price fluctuations make them less suitable for everyday transactions and store of value. Stablecoins solve this problem by maintaining a stable value, typically through collateralization or algorithmic mechanisms. The most popular stablecoins, such as Tether, USDT, USD Coin, USDC, and DAI, are pegged to the US dollar, ensuring their value remains close to $1. The adoption of stablecoins has skyrocketed in recent years, driven by their utility in trading, cross-border payments, and DeFi. Traders use stablecoins as a safe haven during market volatility, allowing them to exit positions without converting to fiat currency. Remittance services leverage stablecoins to facilitate fast and low-cost cross-border transactions, bypassing traditional banking systems. In DeFi, stablecoins serve as the backbone of lending, borrowing, and yield farming protocols, enabling users to earn interest and access financial services without intermediaries. The role of stablecoins in cryptocurrency markets. Stablecoins play a critical role in the cryptocurrency ecosystem, providing stability, liquidity, and accessibility. Here are some of their key functions. Trading and liquidity. Stablecoins are widely used as a trading pair on cryptocurrency exchanges. They provide liquidity to markets, enabling traders to move in and out of volatile assets quickly. For example, instead of converting Bitcoin to fiat currency, traders can convert it to USDT or USDC, preserving their value while remaining within the crypto ecosystem. Cross-border payments. Stablecoins offer a faster and cheaper alternative to traditional remittance services. By eliminating intermediaries and leveraging blockchain technology, stablecoins enable near-instantaneous transactions with minimal fees. This is particularly beneficial for individuals in developing countries who lack access to traditional banking services. Decentralized finance, DeFi. Stablecoins are the lifeblood of the DeFi ecosystem. They are used as collateral for loans, liquidity in decentralized exchanges, DEXs, and rewards in yield farming protocols. Their stability makes them ideal for financial applications that require predictable value. Hedging against volatility. During periods of market uncertainty, investors often flock to stablecoins to protect their portfolios from price swings. This flight to stability highlights the importance of stablecoins as a risk management tool. Financial inclusion. Stablecoins have the potential to bring financial services to the unbanked and underbanked populations. By providing access to stable digital currencies, individuals in developing countries can participate in the global economy and access essential financial services. The future of stablecoins. As the cryptocurrency market matures, stablecoins are expected to play an even more prominent role. Here are some key trends and developments shaping the future of stablecoins. Central bank digital currencies, CBDCs, governments and central banks worldwide are exploring the development of CBDCs, which are digital versions of fiat currencies. While CBDCs differ from stablecoins in terms of issuance and control, they share the goal of providing a stable digital currency. The rise of CBDCs could lead to increased competition and collaboration with stablecoins, potentially reshaping the financial landscape. Regulatory clarity. As stablecoins gain mainstream adoption, regulators are paying closer attention to their impact on financial stability and consumer protection. Clear and consistent regulations will be essential for the long-term growth of stablecoins. Regulatory frameworks could address issues such as reserve requirements, transparency, and anti-money laundering (AML) compliance. Algorithmic stablecoins. Algorithmic stablecoins, such as DeFi, use smart contracts and algorithms to maintain their peg without relying on collateral. These innovative models offer greater decentralization and scalability but come with unique risks, such as vulnerability to market shocks. The development of more robust algorithmic stablecoins could expand their use cases and adoption. Interoperability and cross-chain solutions. As the blockchain ecosystem becomes more fragmented, interoperability will be crucial for stablecoins to maintain their utility. Cross-chain solutions, such as bridges and interoperability protocols, will enable stablecoins to move seamlessly between different blockchains, enhancing their accessibility and functionality. Integration with traditional finance. Stablecoins are increasingly being integrated into traditional financial systems. For example, payment processors like PayPal and Visa are exploring stablecoin-based solutions for cross-border payments and merchant transactions. This integration could accelerate the adoption of stablecoins and bridge the gap between crypto and traditional finance. Sustainability and transparency. Concerns about the environmental impact of cryptocurrencies have led to a growing demand for sustainable stablecoins. Projects are exploring energy-efficient blockchain networks and transparent reserve management to address these concerns. Greater transparency in reserve holdings and auditing processes will also build trust and confidence in stablecoins. Expansion of use cases. Beyond trading and DeFi, stablecoins are finding new use cases in areas such as payroll, supply chain finance, and charitable donations. For example, companies can use stablecoins to pay international employees quickly and cost-effectively, while charities can leverage stablecoins to distribute aid transparently and efficiently. Challenges facing stablecoins. Despite their potential, stablecoins face several challenges that could impact their future growth. Regulatory uncertainty. The lack of clear regulations poses a significant risk to stablecoin projects. Governments may impose strict requirements or even ban certain types of stablecoins, limiting their adoption and utility. Centralization risks. Many stablecoins, such as USDT and USDC, are issued by centralized entities that hold the collateral reserves. This centralization raises concerns about transparency, accountability, and the potential for censorship or freezing of funds. Market volatility. While stablecoins are designed to maintain a stable value, they are not immune to market shocks. For example, the collapse of Terra USD, USD, an algorithmic stablecoin, in 2022 highlighted the risks associated with unstable pegs and insufficient collateralization. Competition from CBDCs. The rise of CBDCs could pose a threat to stablecoins by offering a government-backed alternative. However, stablecoins may still have an advantage in terms of decentralization and accessibility. Security risks. Stablecoins are vulnerable to hacking, smart contract vulnerabilities, and other security threats. Ensuring the security of stablecoin platforms and reserves will be critical for maintaining user trust. Stablecoins have become a cornerstone of the cryptocurrency ecosystem, offering stability, liquidity, and accessibility to users worldwide. Their role in trading, cross-border payments, and DeFi has transformed the way we think about money and financial services. As the market continues to evolve, stablecoins are expected to play an even more significant role, driven by trends such as regulatory clarity, interoperability, and integration with traditional finance. However, the future of stablecoins is not without challenges. Regulatory uncertainty, centralization risks, and market volatility could impact their growth and adoption. To realize their full potential, stablecoin projects must prioritize transparency, security, and sustainability while working closely with regulators and industry stakeholders. In conclusion, stablecoins represent a powerful innovation that bridges the gap between traditional finance and the digital asset world. By addressing the challenges and embracing the opportunities, stablecoins can pave the way for a more inclusive, efficient, and transparent financial system. Whether you're a trader, investor, or simply curious about the future of money, stablecoins are a trend worth watching as they continue to shape the future of global finance. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.